Market's rebound continues to build steam, just chugging away just a little bit at a time. The S&P 500 logged its third straight gain, its sixth gain in the past 7 trading sessions. Climbing above and staying above 6,000 as bulls regain control ahead of tomorrow's CPI report. Tech, of course, led the charge again, supported by falling yields, slightly falling yields, easing yields, I guess would be a good way of saying that, and renewed optimism around growth. And today's market outlook will break down what's driving the strength, key levels to watch, and a trade idea as usual to take advantage of this bullish momentum. So let's go ahead and get started. Today is Tuesday, June 10th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, again, if you're following us on our blog, there is a new format to the Market Outlook post. You can see there's content here below the video. There usually hasn't been content below the video, but there's a lot of content here down here and charts below the video that kind of review. So check that out there. Remember, you have to be subscribed to our site to see that. And you can just subscribe here when you go to our pricing page. You can just subscribe for our basic plan. That basic plan allows you to see the whole Market Outlook post. You can just click on that, subscribe for free. If you're already a subscriber for free, you can just click the login button, and there'll be a login button there as well for you to be able to see that. Remember, our foundation tier is live now. So when you click on either one of these buttons here or up here at the top, you can click on Join Now. It takes you to our Market Outlook Foundation page. And you can kind of get some ideas. And again, I appreciate the comment there from Mike about our Market Outlook post. But again, it's $29 a month, works out to being just under $1.40 per video. I believe it's an incredible value for you guys. If you do the yearly plan, you get 2 months for free, and you get $1.40 per video. So, just under $1.20 per video. So really good value there, whether you're doing the monthly or the yearly plan. So check that out. That's live. Again, you'll be able to watch the full video for the rest of the week as I let you guys know about this. But this video on this page, starting next Monday, will just be a shortened version, about a 5-minute version. And then there'll be a separate page that will be live for you to be able to watch the full version of the Market Outlook behind that paywall there. So you can subscribe at any time, but if you subscribe before the end of the week, then I'll send out over the weekend an extra video for you, a sector rotation video, kind of like what I talk about in my technical analysis trading room for our premium subscribers. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate posture still remains strongly bullish. Nice move today, not that much bigger, about 15 points bigger of a range, but still, just barely above the average. But remember, that's when you get closer to these highs, and you've been bullish for as long as we've been bullish now for, since April the 8th, but really since April the 21st. It's been just kind of every day almost has been an up day here. Very few down days in between. That's what's going to happen. Market sentiment's rising. We're still, intermediate line still well above market sentiment after the crossover here post the 8th. The near-term line still in bullish territory. We're still on the same near-term run since this low point, so we've been right there. So we're still on that same near-term rally. The momentum line is down in bearish territory, but it's not oversold. So, this is about as good of a situation as we could possibly have on the S&P 500 now. So very good market forecast pattern. If you look at the NASDAQ 100, same thing. It's approaching new highs, but still not there. Obviously, it's 22,000 to, it's twos. The deuces are wild here, and we're almost at 22,000 as it is. The near-term line's higher, the momentum line's up. So there's that. If you take a look at the, let's see here. Let's go to the Dow Jones Industrial Average. It looks very similar. The near-term line has popped up more. So you have the near-term line popping up there. You can see the intermediate lines up. The S&P, or the Dow, is up above, so over 2% above its moving average, the intermediate line. Strong bullish posture, market sentiment line rising, so that's good. You have that going forward. If you take a look at the Russell 2000, again, same thing, right? Strong bullish posture, intermediate lines rising, the market sentiment's rising, the still in the same near-term run that we've been on since, I guess this low point on May 23rd. So everything's looking pretty similar. The difference is the Russell's not anywhere near. Remember, the Russell started the correction earlier than the S&P, so it went a lot deeper than the S&P and is not anywhere close to its highs. And really not the same thing could be said for the Dow Jones. Nowhere close to its highs either. But, still, I mean, this is the nice pattern, right? This is the grind. We're over 2.5%. As long as we're over 2.5%, you can see here. Let me zoom out so you can get some context on this indicator down below. As long as you're above 2.5%, you can see being above 2.5% is actually a very strong posture when you're first getting started. So when we came off this October low, we jumped up about 5%. We were down quite a bit. We popped up, and you can see it was a nice, good run here to the upside, and then we just kind of hovered around 2.5% plus or minus a little bit for the rest of that time, going into this bullish pullback right now. So same thing when you look at some of these other, when you first start off coming off of these lows, you get above this 2.5% mark, and then you just kind of hang around. So right now we're still in that stage of we're still above the 2.5% mark, and it's rare for us to be above 2.5% and then go to zero. I mean, it's not uncommon, but usually that happens during corrections, and obviously we are, as of right now, I would say we're not in a correction anymore. Because of, again, we're up to new highs. We had a couple of clusters there. So that's a good posture, right? That's a good trend. It's a good posture, and it's going to be boring. And that's just, we have to take that, right? We're not going to make, big bucks right now. And we've got pretty much a 0% return for the past 6 months. That's the nature of the beast, right? That's the nature of when you've had a correction, you've come back from that correction, and you start to grind higher. In fact, if you look at, post the 2022 correction over here, when we got up to these highs we stalled, right? First of all, we got up to these highs, the pre-pullback highs, and we stalled at that point. Then up here, this is where we got to the pre-correction highs, the correction of 2022, and we stalled there for about an expiration cycle before we finally broke out right at the expiration date, and then we just continued higher from there to the upside. So that's kind of where we're at right now. We're grinding into the highs, and we tend to stall at those highs. Those pre-correction highs, we tend to stall there. So that's what's going on here. That's what's going on right now with the S&P 500. So things are looking pretty good, right? As of right now, things are looking pretty good for the large cap index, and for that matter, the small cap index too. If you take a look at like the dollar index, we're still not necessarily so good, but that's good for the S&P, right? When we're bearish, the S&P tends to be pretty bullish, as has been, again, since this April 21st timeframe when the dollar hit its low point. But we've been, kind of downward ever since, and the S&P's done very, very well from that point. The posture is in the lower reversal zone where market sentiment is. Same thing with the 10-year yield. If you take a look at the 10-year yield, oops, let's put on the actual symbol there. There we go. Strong bullish posture, but not breaking out, right? Still below the 4.5% mark. Intermediate line still above market sentiment, still in bullish territory, but not breaking out there. So, I mean, this is the sweet spot, right? The dollar's down, yields are up, but not breaking out. And that's the sweet spot for risk appetite. And we're seeing that in this kind of, again, like I said last night, not a complacent market, not an extreme complacency market, but a confident market. I mean, we're in a market right now where there's not a whole lot of downside risk. There's not a whole lot of upside gains, but there will be if and when we break through these old highs, and we'll start to pick up some gains. But as we get into these old highs, we're just going to slow down and potentially for another cycle, and because we got another week plus of the current expiration cycle, so we'll probably grind through the July cycle again. based on past precedent alone, is where I kind of make that statement. And then again, once we break through 6150, then there's, as we've seen in the past, when you break through pre-correction highs, there's kind of no looking back, right? You get a good trend going from there, and then, however long that takes until the next correction. Went from 2022 to, 2025. So, it took about 3 years between corrections, 2+ years between corrections here. And that's kind of something we would expect, if and when, again, we get through 6150 and we end up holding that breakout. But until then, it's a grind. All right, now let's take a look at the weekly chart. And you can see again, bullish candle, bullish Hakunashi candle. The size of the candle is above its moving average. The PPO is rising. You got a positive PPO. In other words, the 10-week is moving away from the 40-week. So that's a good sign. A higher Hakunashi close, a higher high. So very, very bullish. And as of right now, the Hakunashi close at 60.20. We're trading at 60.38. The open for next week is probably going to be around 59.50 plus or minus, because it's the midpoint of this body, and we're currently trading above that pretty easily. So as of right now, again, it's only 2 days into the week, but there's a good chance that we have a bullish candle next week too, as long as things maintain themselves for the rest of this week. We have, let's see, we didn't get 3 green arrows yet. We're still just barely negative on both the NASDAQ and the S&P. The S&P is a little bit closer. We do have the 3 green arrows for 3 straight days now on the Russell 2000, and then 1 day here on the Dow Jones. So that's a positive sign. And that's how close we are to 3 green arrows again on the S&P. Now, once you've had an extended run of 3 green arrows, you tend to not get more extended runs. You only get like fits and starts. But as long as they're not 3 reds, if it's 1 red or 2 reds, that's okay, right? As we just saw, we've been, look, since May 23rd, we've had at least 1, if not 2 reds, and we've been bullish up 4% this entire time. So, it's not the same as when you got 3 greens and you're going from a 3 red arrow situation trend to a new 3 green arrow trend. Then, yeah, you're going to have 3 greens for an extended period of time. And then, for a good return as well. And then it will start to slow down, right? So you can see that here, and then you slow down. You can see that here when we made that run up to the upside. Again, getting through those. This is when we got up to the pre-correction highs from 2021, 2022. And then we broke through. We had a nice good run. When we broke through to past that pre-correction high, we had a nice good run. But again, fits and starts after that. So, you get your bigger runs early, or when you're breaking through resistance. Here's the one that's early, and we're going to kind of grind until we break through, and we might, it's assuming past precedent, we might get one again at that period of time. If we take a look at some of the other oscillators, let's take a look at the DMI and the DMI here, the ADX. The ADX is slowly rising because the positive indicator on the directional index rose up almost above 30. But still not a trend. And we're still as bullish as this has been. Again, it's still not a trend because 1, 2, 3, almost 4 expiration cycles, and we haven't gone anywhere. So that's why it's reflecting in this. We're still not necessarily bullish here. We've just recovered what we lost. That's essentially that's what the DMI is saying, is we've essentially just recovered what we lost. But we still maintain bullish strength on the RSI. We got a bullish CCI as well. If you look at the Ichimoku cloud, still well above the cloud. The cloud's huge. So we have a mature bullish trend down here. The rate of change is clearly positive. No break of even the green line, much less the blue. So really no concerns right now, which again, would be a bad thing if we were just overextended, but we're not. We're not over, as you saw with the DMI, we are not parabolic in the least bit. So we are hardly overextended. Again, we are as bullish as we are because we were as bearish as we were, and that's okay, right? Now, again, once we break through those highs, then it's going to be a matter of, then we can go parabolic, and we'll see how, if and when that happens. If you look at the Bollinger Bands and the Keltner channels, as you saw earlier, the bandwidth is way down, but we are well above the bands today. In fact, we got back above the Keltner channel today, so very good move there. The bands themselves look to be, potentially closing back or breaking back out side of the Keltner channels with some increased bullish momentum, slightly, but increased bullish momentum there. If I take a look at the intraday chart, you can see again we got a nice little move at the end of the day today. So higher highs, higher lows, new 4-week high point as you see here, well above 600, 6,000 now. The range is still pretty low, below 5%, but a good pattern on the Arun indicator. You can see the low is going to be here for a long time, again, barring a change. The point of control is right at the chart's midpoint, so we're not nearly as top heavy. So now we have, again, how I told you, it's a lot easier to move down, but the point of control is right here. So it's going to be very hard to move. We might get out of bullish territory, but it's going to be hard to break into bearish territory below the 40th percentile because of that strong support on the 4-week chart. So that's actually a really good thing. Again, the volume and the trading ranges are really low today. The volume or the trading range, you can see just over 4 points. The volume was also, not surprisingly, lower. It did hit the average, right, 66 million, but again, remember that average has been coming down, as you see here. It's at a lower level compared to where we were. But the ATR, it's dropping like a rock, and that's the bandwidth. Like every volatility measure is dropping like a rock to the point where now we're just kind of steadily moving. And as I said, if the VIX was down like well below 15, then we'd be concerned about being overextended. If the VIX was below 80%, we'd be concerned about like extreme complacency. If the VVIX was below 80, we'd be concerned about extreme complacency. But we're not. We're at like literally sweet spots here on volatility, which again shows not necessarily complacency, because that implies that we're overextended and overbought, but it's more of a quiet confidence in the market that we can just kind of grind higher and trade on. Like in our directional option strategies class today, we talked about the kind of bullish trades we make right now, considering how bullish we've already been and considering how strong the sentiment is in the markets. How can we take advantage of that, at least going into July expiration? And obviously after that, hopefully, that's when we'll get our breakout up to new highs. And then at that point, we can be a little bit more directional, a little bit more bullish going forward from there. Now let's take a look at what's driving this price action. And again, let's just zoom in on today alone. So let's go out here to June the 10th. And you can see, it was equity driven. Right? You had Qs rising, the IWM rising, emerging markets rising. It's really developed markets. But you have to remember, developed markets have been a relative outperformer. So it's going to start to lag a little bit from a relative strength standpoint. So that's not necessarily a bad thing. The dollar was up today, but very marginally. I mean, these are very marginal moves on these. The commodities down just a smidgen. Bonds are up, which means yields were down. And you saw that when I showed you the market forecast chart. But let's take a look at this chart here. You can see, how yields did today, and you can see down 4.5, below the 4.5% mark. But again, the sweet spot, that is the sweet spot there. We want to be pushing up against the upper bound of the Fed funds rate, but not necessarily breaking through. That means that the Fed's got the Fed funds rate where the market wants it. Because look how we've been here for most of the past year. We've been in this range. This is the sweet spot. We don't want to break out like we did here at the end of the year, and we started into a correction a little bit later. We don't want to get to the bottom, break out to the downside. That means the economy's struggling. The Fed's, remember on April the 8th here, right here, after dropping below 4%, at one point in time, the Fed had the futures market had priced in Fed cuts starting in June, going all the way through the end of the year. So 5 cuts through the end of the year. That's pretty much recession, because you get an extended rate cut cycle like that. That only happens during recessions, during bear markets. So that's we don't want to break through the downside. So we just want to stay above it. We're above moving averages. We're kind of trending higher, but we're not. There's not a whole lot of momentum to break through, which would only happen if there was either very strong economic growth potential, which obviously we don't have, or inflationary expectations re-emerging. And that's what we don't want to see, because that would ultimately, that's your three-headed monster we talked about: rising yields, rising dollar, And you can see the dollar index again still kind of holding around that 100 level. But if this were to start to rise again, similar to what we saw over here in August and September, like, you know, from this September 30th on through the beginning of January, it wasn't necessarily a bearish move for the dollar or for the S&P 500. Here, let me pull this up and you can see the change. So right over here. So from this point, you can see it wasn't a whole lot of, like, we weren't bearish going into the end of the year, but there you can see the volatility we had, right? I mean, there's strength in the dollar. There's going to be volatility in the markets. You know, there was some positive correlation there, but that's, you know, it's generally a negative correlation between the two. And you can see they both went down during the correction, but as it stayed down, the positive correlation reemerged and we got a new strong run up to the upside. So, you know, that's a good sign. As long as it stays down here and doesn't kind of double, I mean, it's in the process of forming a little bit of a double bottom. And as we mentioned, a kind of a little bit of a long-term convergence pattern on the daily chart here. If I were to take a look at the same chart, but look at it on a weekly basis, you can see we're below the 200-week moving average. So that, like, that this isn't just a, you know, it's a little bit similar because we were below, but we were well below, and we were below it for a while. I still think there's some downside to the dollar, even if there might be a little bit of an intermediate swing to the upside. But, you know, we're probably not going to get to 115 anytime soon. But if we get back up to moving averages, that wouldn't be a shocker. But I think after something like that, there's still some more downside to go before the 50-week crosses below the 200-week, and we'll see how, if that happens, how much longer and how much further the dollar has the downside, which I believe would be, you know, the normal correlation is that would be bullish for the markets, and we'll see if that normal correlation plays out again in an environment that's not necessarily inflationary right now. Of course, the other big move was commodities, and commodities have also been in the bear market. You know, extended run below the 200-week moving average, which is my definition of a bear market. You can see we broke down here in April at the lowest point of that. You know, when we were kind of crashing out and the, you know, economic expectations were dire. You know, we had the negative estimates for the first quarter this year. But then we kind of bottomed there, and we've been rallying, and we've been, you know, holding up above moving averages, but not really pushing through. We still got a very large overhead resistance above us. So it's going to be hard for commodities. Again, it's a little bit of a sweet spot. We're not breaking down because economic growth expectations are plummeting, but we're also not breaking out with rising inflation expectations. So, you know, this is kind of the best case scenario here. Again, looking at the McClellan oscillator, you can see we're still positive, but not, you know, not trending. But that's not going to, you're not going to be trending usually. When you can see, like over here, when we got up here and we got up to old highs at the end of the year, we had strong breadth. But then after that, while we still continued higher, once we broke past the pre-correction high, we didn't have strong breadth. I mean, it was positive and it fluctuated, but it was still positive on here. So, you know, it's okay. It doesn't have to be up above. It doesn't have to be up above the, you know, 35. I mean, that's the ideal scenario, especially when you're first starting. But it doesn't necessarily have to be, as long as it's positive. And the summation index, when you get above 500, it's kind of hard for it. You can see once it peaks, you know, you can still stay above 500, but it's hard to maintain very strong breadth there. In fact, when you look at the breadth, let's see here. Let's go to the breadth on this chart. Give it a second to load up here. So when you look at the breadth indicators that we like to look at, especially the number of stocks above their 200-day moving average, right? Look at that. Like, again, it's not breaking above 300. It's not a huge breakout, but it's back at least above the average, and the average is rising, and both lines are above 250, so the midpoint. Because the more we break out there, the more this breaks out. Right? And there's two breakouts. So we don't want this kind of breakout where you're already above one and you're falling, right? Because the number of stocks above the 50-day moving average are falling. and faster than the 200. So that's the kind of breakout we don't want to see. We want to see this kind of breakout where you're well below 1, you have this big fall, you're well below 1. Now the number of stocks, because the number of stocks above the 50, jumped up higher, and we've seen that, right? The number of stocks above the 50 have really cleared up to high levels, almost back above 400 again. So very strong move there. But once we get the number of stocks above the 200 starting to rise, then we'll start to slowly break up above this line and really get going, right? And again, this is where we broke up right here, is where we broke up past pre-correction highs in the S&P. And you can see we were in the midst of a pretty strong run in breadth, and that's the ideal scenario of what we'll get this go around, right? Again, it's not the greatest breadth, but it's improving. It's definitely improving. And the number of net new highs and lows is still at least above 100. It's above 0. It's above 100. It's not good. It's not huge. It's not great, but we don't need it to be huge because it takes some time, right? It takes, as you can see, by the time we finally got past, it took a big surge just to get to the pre-correction highs, and then it took a big surge after, and that's probably what we're going to get here. We're probably going to get one last little surge, probably not this high, but one last little surge to get to these pre-correction highs. But then if we get a surge like that afterwards, then we're going to be on a good bullish move here for a while. So very good technical scenario setting up in the markets. Again, it's boring because we don't have a lot of participation, but it's improving. And as we approach those old highs, we have a chance for, we've seen this happen before where you kind of struggle for a little bit, and we probably will. And a lot of people will look at that as a sign of weakness. It's like, oh no, we're going to hold those highs and break down. But then once you break through, and whatever the catalyst will be, it might be a trade deal with China, who knows? But whatever the catalyst will be that pushes through those old highs, once we break through and we get some good volume or good breadth, then we can really put those old highs behind us. And in this case, we went up quite a bit. We went up from 1400, or excuse me, minus 1400. But on the S&P, where did we end up coming up to? Here, let me go over here. So we end up going up from over here at about 4,800 to ultimately a peak of 6,100 within a little bit more than a year. Once we put the pre-correction highs behind us, that's kind of, again, we're not going to go up the same amount because the CAPE ratio is already a lot higher now than it was over here in the end of 2023. In fact, when you look at the CAPE ratio now compared to then, you see what I'm talking about. So we're not going to have the same return. So here's we'll go monthly, and we'll go by month. So the end of 2023, you can see the CAPE ratio was in the low 30s. Well, remember, that's when we broke through the old pre-correction highs from 2020, early 2022, late 2021. So we have, those highs, the CAPE ratio was at 36, 37. And by the time we broke through those, the CAPE ratio was back down to 31, almost 32. So we had room for it to go up. So then it peaks here at the beginning of the year around 37, and we're already back to 37. So, and we haven't broken through the highs yet. So again, that's going to limit. It's not going to mean that we can't go up. It's just going to limit the size. So it won't be, the huge move, we had here, right, from and again, not counting coming off the low, but once we broke through the pre-correction highs, so about right in this area here. So right there from that peak, so let's go after that peak all the way up to the high point. So 27% return in 273 trading sessions, so just over a year. 252 is a year, so just over a year, a 26% return. That's not bad, right? And some volatility along the way, but nothing major. But we're not going to get that. It's probably not going to be 26%, but we'll take an extra 10-12%. We'll take that kind of return over the course of a 12-month period. And you remember the rate of change. If I were to look, well, let's go down to the long-term rate of change on this Copic curve. The 12-month rate of change right now is still at 10.5%. So as bad as we, had gotten down here, we never really we're still pretty strong in the 12-month returns. So, again, if we get a 12-month return of, low double digits, that's going to be okay, right? That will definitely be fine with something like that. Again, post 6150. That takes us now to our trade idea of the day. So let's take a look at Google. Google's had a nice return, nice move today, a little bit of a breakout move. Again, it's been bouncing off of a little bit of a near-term decline. So a pullback didn't quite get the three red arrows or bull tag. In this case, a bull tag on this chart. We did get light pink shading, and then we've rebounded up to new highs, and it's been pushing up pretty well. The intermediate line's back in the reversal zone. Market sentiment line is now out of bearish territory, so it's rising. So that's a good move for the stock. If you take a look at its weekly chart, it's going to look very similar to the S&P. But in this case, like, it still hasn't got the golden cross yet, and we just barely really have clearly moved this week above the 200-week moving average, the 40-week exponential moving average, the proxy on this particular chart for the 200-day moving average. If I take a look at the 3 green arrow chart, obviously we have 3 green arrows. That's a good sign. We've had 3 green arrows. We had a couple reds for during that near-term decline. We're back to 3 greens, and we're moving up. So remember, we don't have to stay green. Like, we can get a red arrow or 2 and still stay bullish eventually, right? So, as long, any days we get, the more days we get green, great, but it doesn't have to be. We've already had our, change from bearishness to bullishness and our extended run there. And so here we are starting a new one. So that's a good sign for the stock. If I were to take a look at some of the other oscillators, so take a look at the DMI here. And you see, okay, we're well above 30 on the positive indicator, below 20 on the negative. You can see the ADX is rising, so that's good for the stock. If I take a look at the RSI and the CCI, you can see above 60 on the RSI, good, right? The RSI CCI is above 150, that's good for the markets. If I take a look at the Ichimoku cloud, you see we're well above the cloud. We haven't got to the green shading yet. Remember, it's always plotted 26 days away from the crossover here. But we're getting closer. It's a pretty clear cloud. So that's good. We're well above the green and the blue lines. The rate of change is clearly positive. We don't even have a mature trend yet. So that's good, right? We're above 2 or above 65, and we're kind of working our way into that area. If I take a look at the the Bollinger Bands and the Keltner channels, you'll see that we are above the upper band. That's good, right? Bandwidth is down, but not low. This is lowers. It's not at a low point. We are above the upper Keltner channel again. A little bit of a long upper shadow, but the momentum is still strong. So what I decided to do here was to do, obviously, a bullish trade. And we did a long call, considering, like, we don't know, like, the trend hasn't even turned mature yet. But there's an opportunity for us to stay mature. So if you take a look at, we went out to July, the July contract, and I know I'm inside of 50 days, but I did it because the cost was a little bit cheaper. I was able to do a couple contracts here, and yes, that means, the downside of this is I don't have very much time left before expiration, so the delta swings are going to be a lot bigger. But I feel pretty good about the upside potential of this, that I think that we'll be able to get to an 86 delta if we were to continue to move higher pretty quickly, and then be able to roll this out to August and get outside of that 50-day window, which, we have about 16 days to do that. So long call bullish trade, you can see I got the 50% stop order. When I buy at the money, I go for the 50% stop order. And you can see where my stop order is. So if we were to break back down, obviously it would take a clear change in momentum for the stock. We'd have to break. Let's see. I don't know where it would be here on this chart. Oh, there's our stop order. We'd have to get back below the point of control and really kind of, after breaking out above these highs, get back below those highs. And then, like I said, if that happens, we end up losing what, 300. See, I have the $600, so half of that where a 50% stop order is, which is about the range that we put for about the $500 risk for our directional trades. And this is clearly one of our bigger directional trades. You can see the delta is pretty high. And if I were to beta weight, you get the idea that the delta is pretty high. This is one of your stronger bullish moves relative to long call verticals, or especially bull put spreads. They tend to be the least directional out of those directional option strategies. And there's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. You can also reply to the Market Outlook tweet on any comments you have. You can also comment at the bottom. There was a great comment last night. I appreciate that. Mike, from Mike Wilson there, about the new format of the Market Outlook post. So those are different ways that you can comment on today's post. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon and comment on the video. Follow me on Twitter for more content and Facebook, and like our content there to help get that content out to other people that follow us on those accounts. Again, remember our foundation tier is now live. The videos will continue to be free for the rest of this week, but next Monday's video will be behind that paywall. But as you subscribe here during this week, you'll get that bonus video on sector rotation that I'll send out over the weekend. So remember, that's out there for you as well. So if you have any questions, just email us at support@marketscholars.com. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.